All right, hi, welcome to the Interaxis YouTube channel, interaxis.io. Today we're going to talk about custody. Custody has been a very important topic lately, especially in the cryptocurrency, blockchain, digital asset world. There have been a lot more crypto custodians. So we want to talk about what custody means in the digital world, but to do that we have to go back and talk about what custody means in the traditional financial world. So back in the day, we're talking about late 1800s, early 1900s, everyone did what was called self-custody. And this was mainly in the equities market, right? So if you owned a share of stock or several shares of stock, we'll say you own shares of GE stock, which is an odd one to talk about now with the problems that GE is having, but you imagine this was a very important company back at the turn of the century. So you might own a few shares of GE stock. Okay. You would own that GE stock. You were probably one of the, potentially one of the original investors in it, and you were owning it so that you could get the dividend that they might pay annually or quarterly or something like that. And you would have these stock certificates that you would actually physically have in your possession. If you were in a house or an apartment or something, you physically held on to these stock certificates in your home. And GE kept a record of everyone that owned stock certificates. And they did that so that when they sent out dividend checks, they could physically mail you a dividend check. And you held on to these stock certificates in their paper form in your home. Now what happened was, these stock certificates might not be safe sitting in your home. They might be subject to fire or flood or theft or loss or something like that. So it became less safe to keep them in your home. So people might go to companies that they felt safe with, companies like banks. Okay, they might go to the bank and they say, hey, can you hold on to my stock certificates for me? The bank said, sure, we can. So in that, the bank offered some level of custody for security purposes, right? The bank held on to them. You felt safe with them being at the bank, kind of like in a safe deposit box. But in this case, the bank physically took custody of these stock certificates, and you would sign something over to say the bank is holding on to my stock certificates, but they are still mine. I still own them. The bank is just taking custody for safekeeping. Okay. Now keep in mind, this was still at a time when most people owned stocks for the purposes of receiving the dividend, not for trading and exchanging. It was mainly for purposes of receiving the dividend. There wasn't as much exchange of stocks. It wasn't a very easy thing to do. So banks were the kind of the first custodians that would hold on to your stock certificates for security purposes. All right. Next, we start talking about wanting to exchange the stock certificates, right? So now I want to sell, I might want to sell my certificates. So you have Adam that has 100 shares of GE, and I might want to sell them to Ron. Okay, Ron's going to pay me $1 each, so $100 for the 100 shares of GE stock. Now, even though the bank has custody of my stock certificates, I still have to physically get these shares of stock to Ron, and Ron has to give me the money. Now on top of that, we then have to tell GE to augment their record so that Ron is now the owner of record instead of me. So there's a kind of a difficult transaction. On top of that, we might physically be walking shares of stock through the city or across the country in order to make this exchange. Okay, so now you see custodians having to come into play, not so much for the security aspect, but for the efficiency aspect. We need greater efficiency in being able to exchange stock or trade stock. Okay, in addition, as you have stock exchanges in existence, it is a lot easier to sell stock via a stock exchange if there is a custodian that is showing the record of ownership rather than my physically having to go show the exchange that I have ownership of these shares of stock. So in terms of ease, efficiency, security, now you have a custodian that is performing the functions of holding the shares of stock, of securing, of recording, and of transfer of the shares of stock. So now the custodian is helping me keep my shares of stock safe, and they're helping me with transferring those shares of stock, whether it's an exchange or a peer-to-peer exchange, something like that. They're helping me by facilitating these functions with my equity. So the custodians have become bigger and bigger and more powerful and more necessary, especially as there are more people in the country who were able to buy and sell stock. And you had the stock exchanges become more prevalent, and people wanted to actually own and trade stock not only for dividends but also for growth prospects and such. You have people actually investing their money into stocks rather than just keeping it in the bank. As more and more people are doing that, you have more need for a custodian. So now, in addition to the custodian, you have what's called a transfer agent. And the transfer agent is charged with keeping track of who the owners are, right? So as the stock went from Adam to Ron, originally GE is kind of the record there. Now they have outsourced that to a transfer agent. So the transfer agent keeps track of the fact that I sold 100 shares of GE to Ron, or I sold 100 shares of GE on some sort of exchange. I no longer own those shares. Ron owns them, so that they can know who owns them for distribution, for dividends, for voting purposes, all these things. The transfer agent is the one who keeps track of that. Now, dealing with the transfer agent also becomes a lot easier when the custodian is holding the shares, because the custodian puts the processes in place to make it easier for me, so that when I transfer my shares or exchange them or sell them, the custodian says, we'll take care of informing the transfer agent, Adam, so you don't have to. So all you have to do is know that you own them, and you make the decision as to when you sell them and to whom you sell them. So what happens is the custodians become bigger and more powerful, and they start to offer more and more services on top of just securing and transferring the stock. They offer trading capabilities. They offer accounting capabilities. They offer more and more different types of accounts that I can have. So now, under one custodian, and we will, for the sake of argument, we'll call that custodian TD Ameritrade, and I use them because in our financial practice, they're actually the custodian we use. TD Ameritrade might hold my brokerage account, in which I can trade stocks. They might hold my retirement account. I might get some sort of bank type account through them. And I can be potentially moving my money among all of these accounts, and TD Ameritrade is keeping track of that. And of course, they're charging me potentially fees for all this. They're charging me trading fees. They might charge me a holding fee. They might charge me a fee for my bank. They might charge me a fee to use checks for wires and such. So their goal is to offer as many services under their one roof and under the auspices of being a custodian, as many services as they can to charge as many fees as they can, to get as many clients as they can. It's a volume business. They're keeping my assets safe, and they're giving me the ability to easily transact. But here's something that has changed that has made this efficiency and easy transaction even more important. What happens now is, instead of my being the owner of record of my shares of stock, right? So you have 100 shares of GE still. Instead of my being the owner of record today, TD Ameritrade owns them, is the owner of record according to GE and according to the transfer agent. They're the owner of record. Okay, I might be what's called the beneficiary owner. That means that I get to decide when they get traded. It also means that I essentially get the dividend, but TD Ameritrade is merely making an accounting record of that. So when the dividend goes to TD, and they might own 1,000,000 shares of GE for their various clients, the dividend goes here. It's up to TD to distribute that dividend to all the beneficiary owners. And it's up to TD to make an accounting when I trade the GE stock. And I might trade it, and TD Ameritrade might keep it within their book. They might keep it within their group of GE stock that they own in street name. And then when someone else within the TD world wants to buy it, they essentially just sell it to them. Okay, so it makes the records a lot easier because there's one major party interacting with GE, interacting with the transfer agent, and I don't have to make all these interactions every time there's an exchange. There's a lot less, I would say paperwork, but we know it's all done digitally now. There's a lot less records that have to be moved around when we hold the stocks this way. So this is essentially how custody works in the equity world now. TD Ameritrade might be the custodian for my multiple accounts, and what I do is when I log in, when I call them, whatever, I'm instructing them as to what to do because they are making essentially an accounting record that I am the beneficiary owner of such equities, and I can make those decisions, but TD Ameritrade is the owner of record as far as the transfer agent and the companies go. So I hope that makes sense in terms of equities. Now we can move on to how something like custody works in the debt world. So in the world of debt, in the past, custody has worked somewhat similarly, right? So a company, we'll call them Coca-Cola, might issue debt, and they might issue it in the form of bonds, right? And I might buy, let's say I buy 1,000 bonds for Coca-Cola, and those bonds might be called what's called coupon bonds. And coupon bonds literally is a bond with little coupons at the bottom. And every time I clip one of these coupons off, every month or every quarter, I send it into Coca-Cola and they send me money. I just say, hey, here's my coupon. This is proof that I own this bond, and I want you to send me my interest every quarter or every month. Now, this is another form of self-custody because I get to receive this interest by virtue of the fact that I have actually physically sent them a coupon. If I'm holding this in my house and someone comes and steals these bonds and starts sending in the coupons, well, Coca-Cola is going to send the interest to whoever sent them the coupon. Okay. In addition, at the end, when I want to turn this entire thing in at the end of the term of the bond and get my principal back, Coca-Cola is going to send the principal essentially in the past to whoever sent them in this bond. Okay. Of course, in movies in the 80s and such, you had criminals that were stealing bearer bonds. Well, a bearer bond was simply a bond that said that whoever was the bearer, whoever was the owner of such a bond, was the one who got paid. And that's why you could steal a bunch of bonds and it was worth a bunch of money because you could then go turn them into whatever the company was or the municipality, and they would physically pay you the interest and the principal. And that's what a bearer bond was. It seems ridiculous now to look at those movies and go, I can't believe someone could steal all these bonds and they'd be worth money and no one realizes it. But in the past, the accounting for who owned a bond and who was due the interest and the principal was the fact that they physically had possession of it. Okay, now we all know that most physical possession is accounted for using digits, right? It's all digital. And it seems silly to us, but in the past, this was custody. This was custody of debt. Now, custody of debt looks very similar to what we just discussed as custody of equity, which is you go to a custodian, which could be TD Ameritrade. We'll change now to Charles Schwab, who is another large custodian. Charles Schwab might be the custodian here, and they keep track of the fact that I own this debt instrument. Okay, and they're going to pass the interest payments on to me, much the same way as it happened with equity. Now, there can be custodians for equity and debt. There can be custodians for commodities. Right? So you can have a custodian for corn, for oil, for gold, right? If I buy gold, I might want to go put it in my safe deposit box, and I'm self-custodying the gold. I might have a safe in my house that I want to put the gold in, or I can take it to a gold custodian. I'm going to hand them the bars of gold. They're going to hold on to it in their safe, and they're going to go, Adam has 20 bars of gold sitting here, and we're going to keep a record of that. So that is a gold custodian. So that is essentially how custody works today in the traditional financial world here in the United States and in most developed economies. Custody has become something that is imperative for security, because I don't want to hold on to my equities and my bonds and such and my gold there at my house. It's just not safe anymore. It's done for efficiency. It means that I can actually trade the stock or the bonds or the gold or whatever it might be by virtue of going onto a website or making a phone call, and a bunch of digital transactions can happen, and all of a sudden someone else owns that. There's records of it everywhere, so that the transfer agent, the issuing company, everyone knows that I no longer hold that equity or that bond or that commodity, and someone else does, and they now have the benefit of it. It helps for tax purposes, for dividend purposes, for interest payment purposes, for ownership purposes, for bookkeeping. All of that is very important, and the idea of a custodian, central custodians, have very much helped with the efficiency. Without the custodians in helping out with this efficiency, there's no way that our financial system would function the way that it does. All right, so that's where we come to, is the security, the efficiency, quite a bit of transparency. And going along with the security part is some insurance. And some of this insurance is government-backed and private, right? So obviously custodians have quite a bit of private insurance that they've purchased from insurance providers around the world, and they are somewhat backed by the government. So your accounts are somewhat backed by the government. So if something happens to that custodian, if something happens to TD Ameritrade, a certain amount of your investment accounts, whether they brokerage, IRA, bank accounts and such, are covered by the federal government. So you're protected a little bit by the U.S. to make sure that you don't lose everything because TD Ameritrade or Schwab or Fidelity went out of business. So that's where we are on custody of assets as they are now. Now, how that works in the digital world and in the new cryptocurrency world is very different.